Hey, welcome back to The Market Investor. I'm Daniel Snyder. Thank you so much for checking out this episode. Today we are talking about earnings per share, what they are, what they do, and how we use them to help calculate the PE ratio of a company so we can be better investors and traders. So we're going to cue up the intro. I hope you stick around and let's get into it. So earnings per share, what is earnings per share? It's also referred to as EPS, okay? Earnings per share is exactly what it sounds like. How much earnings is this company making per each share of common stock? That is a key. There's different types of stock, which we'll get into later, preferred stock and stock incorporated into loans and things like that. But this one is referring to common shares of stock, the shares that are out on the outstanding market. So it's really easy to calculate. It's literally just the earnings of the prior quarter divided by the number of common shares out on the market. And that'll give you your earnings per share. You'll hear this often delivered by the company, the CEO, CFO, on the conference call that they do at the end of the quarter. And it just tells you, hey, our earnings per share was $1.30. And you're like, oh, wow, that's awesome. Like, it's a lot better than 60 cents per share, right? So why does earnings per share matter? Earnings per share helps us determine the company's profitability, right? And it's really easy to determine. The higher the number for the earnings per share, theoretically, we think it's more profitable as a company. And we want to invest in profitable companies. We want companies that have an edge on the market or have something that doesn't have a lot of competition, that consumers are paying for or businesses are paying for, and just driving profits, because as we bought that share of stock, we invested in that business to get a share of the profits later on in the future. So earnings per share is actually really important and helps us just determine that. So we use this earning per share number to calculate the PE ratio. Now, we briefly touched on the PE ratio before. It's the price to earnings ratio. So as you probably thought of already, you take the earnings per share number, you take the share price, you take the price divided by the earnings, and that gives you your PE ratio. So why does the PE ratio matter? Well, it gives us insight as investors and traders to determine how much investors might be willing to pay for each dollar of earnings. And that is it's a multiple number, right? So price divided by earnings gives you the multiple, whether some companies have a negative multiple, others have an extremely high multiple. Like, if once you get into 60s, it's like, okay, you are 60 multiple. So pretty much, what are these multiples? Well, the golden rule is kind of, as an investor, you should be trying to find companies that have PE ratios of 20 or below. Just kind of tells you it's a solid company. They're controlling their cash and revenue and everything else. But you also got to dive into what the products are, who the leadership is. People do go up to 25 on the PE ratio, which is also still safe. But don't let this PE ratio number stop you from investing in companies that you really believe in, that you use the products of. Just because the PE ratio might be over 25 or they might have a negative PE ratio, definitely still do your due diligence, do the research, and you could really find something that really just knocks it out of the park. This is just a way of taking the earnings per share, calculating PE ratio, and then determining if this company is a solid company for the long run. One last quick tip for you is, I would say, use the EPS of a company you're interested in, and then compare it to the EPS and the PE ratio of other companies that are in the same sector, right? So if you are interested in Apple, I would go and I would look at the EPS and I would look at the PE ratio, and then I would go to Microsoft and look at their EPS and their PE ratio, and try to calculate just like who's overvalued, who's undervalued, and just try to feel out who might be the better company for you to invest in. Of course, I think they're both great companies, but that's just a grand scale kind of example for you. But I hope you learned something new. I hope you understand now what earnings per share are, how we use them to calculate the PE ratio, and why they matter for you as an investor. I'm Daniel Snyder. This is The Market Investor. Oh, and don't forget to subscribe.